All right, welcome back to the final round here on Yahoo Finance. And it's time now for Retirement Ready, brought to you by Fidelity Investments. We're joined today by Corey Walther. He is a president at Allianz Life Financial Services. And Corey, I want to talk a little bit to you about de-risking retirement portfolios in this environment. On a day like today, the stock market is up quite a bit, but there's a couple of interesting dynamics happening in the retirement market. Not only do you have a huge number of boomers approaching retirement age. But as you mentioned, the millennial generation is now kind of going through their second financial crisis in a decade. And it's created, I think, a more risk-averse generation than maybe some would expect. So what have you guys kind of done to maybe offer some ideas or some products to people who are looking at the world and they're quite scared by what they see?
Yeah, thanks, Mile. It does seem interesting on a day where the markets are having another one of those roaring days, up 2 and 3%. And to have a conversation to talk about de-risking seems so polar opposite. But in fact, I think there couldn't be a more perfect opportunity. Right now, if you really think about how, in many cases, some of the markets have recovered, it almost, in essence, in some cases, depending upon each individual situation, giving them an opportunity for a redo, or another opportunity to think back to pre-COVID or to maybe some of the stock market volatility a few months ago. If people really could do some things differently, are they maybe in a better position to think about taking some of that risk off of the table and using, different tried and true strategies, whether that be timely rebalancing, reevaluating their current risk tolerance against their future retirement goals and so forth. To answer your question, though, we're really excited. Just earlier this week, we introduced a new product offering for us, a new buffered outcome ETF, which was really designed to bring our in-house hedging capabilities that historically have only been available for institutional investors, and now bringing that down to the retail level, which in essence allows retail investors to access fully liquid ETFs on the New York Stock Exchange to still have and achieve some of that upside potential that investing in an index like the S&P 500 can offer. But yet there's a level of predefined outcome and a buffer on the downside, if you will, to really allow people to smooth out some of that volatility and have a more predictable, future for their retirement income.
And Corey, maybe the two products aren't similar, but it seems to me, looking at kind of what the buffer, ETFs are trying to accomplish, similar maybe to what we've seen from a lot of the big retirement, kind of sponsors who have retirement date funds now. They're trying to offer things to less sophisticated investors that maybe make things simpler. Is these kinds of innovations in the the retirement space? Do you view them as similar? Are they different? Is this kind of the way things are going in the industry?
Yeah, I would say, overall, there's a couple of key themes that even based with a backdrop of a very, highly roaring successful day in the equity markets today, some of the continued extensive research that we've seen that maybe your viewers have also had a chance to note, number one is I think investor appetite for risk is declining across generations. As one might expect, I think as baby boomers are, facing, retirement, they're looking for ways to continue to participate in equity-like returns, but at the same time, maybe do it with solutions or products that might take some of that risk off of the table. And frankly, we're also seeing it in the lower generations, even with the millennials, which was quite surprising because for a segment like that, who arguably has time on their side, I think they've had a couple of recent crises, whether that be the COVID crisis and how that's impacted the market, but also going back to 2007 and 2008. A lot of those individual investors that may be younger, they've now faced a couple of different, financial crises that has them second guessing about, is this now the right time to put money to work in the market? And how might they do that in a different way? And so one of the areas that we're seeing, to your point, your question, is just a lot of product innovation, which I think is really exciting, whether that be in the form of buffered outcome ETFs, annuities. We're seeing, the rise in the prominence of annuities being used quite extensively to address things like longevity risk or transferring that risk of outliving one's assets and addressing sort of the catastrophic loss of something that can't necessarily be diversified away. And then we're also seeing structured notes as well. So we're seeing really a proliferation of risk management solutions across the board, which I think is really good for the consumers and investors out there.
Well, and Corey, quickly before we let you go, you mentioned that these strategies are making available to retail what had only been available at the institutional level. And we talk so often about fee compression, and we think about, how cheap the Vanguard SPY ETF is or whatever. But it would seem to me that this is also a form of fee compression. If someone who is a retail investor, even if they have a six-figure portfolio, now has access to something that previously they'd have to have, 8 or 9 figures with you guys to get themselves a cut of.
Yeah, absolutely. And I think, through the, some of the benefits of technology, size and scale, statistically, the actuarial tables will tell an individual that a husband and a wife or a couple age 65, there's a 50% chance statistically that one of them is going to live to the age of 92. And it's, a 1 in 4 chance that they're going to live to be 96 or older. And typically as people grow or have sizable, net worths, they tend to have better access to healthcare and different tools like that. So those statistics tend to even morph even a little bit longer in age. And so that the time that somebody may spend in retirement can be quite extensive. And so individuals really need to take that into consideration in terms of how can I still continue to stay invested in the market, but maybe do it, accessing and utilizing some of these types of products to take some of that risk off the table.
All right, Corey Walther with Allianz Life Financial Services. Thanks so much for joining the program. We'll talk to you soon. Have a great weekend.
Great. Thanks so much, Miles.